Dear viewers, welcome to this episode of Your Life, Your Money. After a long time, I could see the Indian stock markets in a southward journey. In the last 2 weeks or so, at the time of recording this video, which is on 8th of October, markets have retraced all the way from 86,000 and have come up till 81,000 on the Sensex. What are we seeing in the market? A market correction, a market crash which has set in. What exactly is going to happen? Who is going to get affected with what outcome? All these points I'm going to discuss in this video. Stay till the end of the video. I'll discuss a lot of points which could be of interest to you. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
In the last 2 weeks at the time of recording this video, markets corrected from 86,000 on the Sensex all the way down up to 81,000, roughly about 5% plus kind of a retracement we have seen. What exactly we are seeing? Is it a market correction? Is it markets heading towards a crash? How do you describe this? And what do we see in different markets? If I observe the ways the market is moving, it does not appear like a market correcting or markets heading towards a crash. It looks like a normal corrective phase of the market where assets are moving from one side of the market to the other side. Normally, when the markets crash, they will have a global tendency. That means all the markets across the globe will show a correction. It does not mean that the regional markets will not crash on their own. That's a possibility. They will react to the local circumstances. That's a distinct possibility. But by and large, when the markets correct, there is a global footprint which is visible. Now what is happening? Indian markets corrected from 86,000 towards 81,000. That means people pulled out money. What happened to this money? The money has moved into China. The Chinese market at the same time saw in the same month market seeing a 52-week low and market seeing a 52-week high. When the Indian markets are correcting, Chinese markets are booming. So which means to say somebody who is selling in India could be reinvesting this money in Chinese market. Likewise, different participants of the market, Dow Jones, Nasdaq, the Japanese market, the Chinese market, the Indian market are showing divergent trends. So it is an indication to say that the funds are getting repositioned from one asset class or one region to another region. In India, it's a common knowledge now that the small caps and the mid caps are very expensive. They are very, very expensive. But because of the return that they showed in the past, everybody wants to put money there. The seasoned fund managers, what are they doing? Especially in the flexi caps or people who have an opportunity to move money out of the small caps and the mid cap, they are booking their profits in the small caps and the mid cap and putting this money into the large cap. So you will see a corrections in the mid and small cap. However, this money is getting repositioned into the large cap. For the first time probably in the history, the position of large caps, which should have been around 70% or so, has dipped to a level of about 53-55% in the overall market capitalization. This has to correct. So the money which was there in the small and mid caps could be heading towards the large cap. So whatever the movements that we are seeing right now appears to be a corrective phase wherein which excessive valuation in one place is giving up and it is getting moved to another place where it is very cheap. India is expensive. China is very cheap, so the money could be moving from India to the Chinese market. The mid and small caps are very expensive. Large caps in relationship are much cheaper. So people could be selling the small caps and mid cap and could be buying the large cap. Let me use this particular video to give some insights into when the markets correct, what happens, and a few statistics around that. The first thing is, how much can the markets correct? What could be the deepest values the market can correct? I have been in the stock market for close to over 3 decades now. I have been in the market since the late 1980s and now we are in 1924, so which means to say close to about 3.5 decades I've spent. I've seen the market crashes during the Harshad Mehta scam, during the dot-com burst, during the housing bubble scam which happened in 2008. So I have seen almost all these phases. In my lifetime, I have seen one market crash which brought down the market to 60% of the market highs at the index level. If markets correct by 60% at the index level, at the fund level or at the individual stock level, the markets will correct much, much higher. I have seen markets correcting by 50% during the Harshad Mehta scam period. I have seen markets crashing by about 40% over a period of 3 years during the dot-com bust. So the deep corrections in the market is not something that it's a one-off event. They will keep happening. When will the markets correct so deep? The markets will correct so deep when the valuations become very rich. Everybody has poured all their money. Liquidity becomes tightened. There will be regulatory actions around it, and some incidents will pierce this balloon and the markets will come crashing down. Are the valuation of current markets so rich? The answer, I do not know. What I can say is markets are showing a very rich valuation, but it doesn't show up like something what we saw in during the Harshad Mehta period or 2008 period or 2000 period where we saw the dot-com bust. It's nowhere near that. So it's very unlikely that 40-50% kind of a corrections are something which we are looking at it. So nothing to be scared about to such an extent. But it doesn't mean that I know everything about the market and I'm a market guru and what I say market will do. I don't know. Markets can do anything of its own. Market has a mind of its own. It doesn't care for anyone. It does what it needs to do. So I'm just telling from the historical perspectives what might happen. Market retracing from about previous highs 10%, 20% is a routine affair in the market. That keeps happening every year. Every year you will see at least 1 or 2 times where you see the markets correcting by about 10%. That's perfectly normal. There are odd years where the markets correct by about 20%, nothing to be worried about. So if the markets retrace by about 10%, 20%, no one has to worry too much about it. Now, when the markets correct, so there is a pattern which is visible. You should see from where the market started the bull run and you can calculate how much could be the retracement value. See, this bull market or this leg of the bull market started somewhere from 72,000 on the Sensex and went all the way up to 86,000 without much of a time interval spending in between. So now 86 to 81,000 it has come. So it's a 1/3 kind of a retracement. So markets can retrace by about 1/3, which we have already seen. They can retrace to 50% of this move. They can retrace to literally 2/3 of this move, which means to say 72 to 86,000 we have seen 14,000, 2/3 of that you take it out. That is where till which the retracements can happen. I'm not telling that it will happen. I'm telling it can happen. But we can say that it is going to be a crash only if markets give up that 72,000 on the Sensex and falls below that. Then we can say markets are coming crashing down. Even the previous highs which they have seen have been taken out. I do not think this market is showing any tendency of that. Let's also look at once the market starts correcting, how long the corrections will last. The market corrections will generally last for a few weeks to a few months. That's the routine corrections. That is the way they will behave. You see a particular high and the markets will retrace, correct, come down. It's a 10-15% kind of a correction. They will last for a few months and the economies will grow and they'll get a better valuation. They'll start moving up. However, if the markets come crashing down, that means there are deeper cuts. I talked about 60% correction, 50% correction, 40% correction. In such cases, the markets will take pretty long time to recover. It could take a few years. During Harshad Mehta period, when the markets went up all the way from 1,000 on the Sensex to about 4,200 in less than 1 year, it was a vertical up move. When you see a vertical up move, the crash will be equally bruising. You stretch a rubber band and if it breaks at a distant point, it will have a recoil. So it dropped down to 2,000. It should have spent time there for a long period of time. But it lasted only 1 year. Why it lasted only 1 year is there was an event at that point of time. Narasimha Rao Manmohan Singh government came, they set India on a reforms path and that gave hope to the market and they retraced. When it crashed during the dot-com bust, during that time what happened? The markets crashed and they remained low for 3 long years. So they did not correct back to their previous level. It took 3 years. Every year for the next 3 years they were continuously coming down. So it took a long period of time. What happened during 2008 housing bubble crash? Markets retraced by 60%. They gave up the valuation by 60%, 21,000 all the way down to 8,000. And it took literally about 6 odd years for the markets to move higher up, which means it's a very bad crash. They came down to 8,000. Of course, there is a recoil. 8,000 was given up. Markets moved to 12,000 and they remained between 12 to 16,000 for next 3-4 years period of time. Then moved up to 18,000, stuck in a band between 18 and 16,000 for 1 or 2 years. And Modi government took over in 2014 when they got an inkling that in 2013 Modi is likely to be elected, and the market started a spike up move. That took out the previous high. When the markets make a vertical move up, you have to be very careful. That is why I'm a little bit concerned that from 72,000 to 86,000, market did not take much time. Within a couple of months, markets have moved from 72 to 85,000. That is not very comforting. Therefore, this retracement, whatever which is happening, is a healthy move which is happening in the market. Now let us look at whether the market corrections are good or bad. When the market corrects, it has a mixture of good and bad. For serious participants of the market, who are seasoned participants, people who know what to do and what not to do, people who invest under the professional guidance of advisors, financial planners, they have nothing to worry about a market correction. It's a routine affair. A market correcting is actually a very healthy move. What do we do when we overeat and you suffer from indigestion? The best medicine is to do the fasting. So a correction is like a fasting for a human body. Periodical corrections are very, very healthy. So we have to think that it's a good thing that is happening in the market. 10-20% corrections that will not do anything for you. If you are somebody who is wanting to buy in the stock market, everyday market climbs up, it gives you a feeling that I'm doing a great thing. But actually, you're buying when the prices are very high. So if you're a serious investor and your time horizon is 5 years, 10 years or more than that, a market correction gives you an opportunity to buy at a lower level. You are always concerned markets are moving higher up. Should I buy? Should I buy tomorrow? Should I wait for a correction? This is a godsend opportunity for you to buy in the market. For those people who invest in the market in a systematic way, you do your SIPs, you do your regular investment into the stock market, be it to the mutual fund, your ULIPs, your ETFs, index funds, anything could be a regular investment. The corrections will help out for you to average out the prices and you can buy units at lower prices. So it all works out positive for those people who are serious and those people who are under professional guidance and who are doing it for the long-term purpose. But for a certain set of people, market correction is not such a good news. Why? These could be the ones who have come at the last phase of the bull market. Bull market or the stock market many times are termed as the last fool theory. You buy and you need one more fool to buy it from you. If you don't find that one more fool, the hot ball will be left in your hand and probably you will see you can't exit that stock or the fund and you don't find a buyer. So if you are somebody who has come into the stock market at the fag end of the bull market, you may be left there high and dry. Likewise, momentum changes. There are people who buy into it because the prices are likely to rise. They get hold of a penny stock, a small cap stock, a nondescript stock. They don't know the quality of this business. The only reason why they buy that is because its prices are changing every day. A stock market crash can completely wipe them out. There are people who participate in the market without having sufficient enough money. If you have your own money and if it is not a borrowed money, you are not at an urgency to repay this money. What if you have taken a loan and you have invested in the market and the market's correct, you are leveraged and you can get stuck. So if you are trading in the fashion of the day, if you are leveraged to buy the required amount of funds or stocks in the market, you could be up for trouble. Especially those ones who are trading in this fashion of the day, futures, options, nondescript stock, a correction can be a great leveler. Probably you will become Tenali Ram's cat and you may not come back to the stock market again. So which are the types of market corrections are there? There are two distinct types of market correction. One is called the price correction, which means the market is quoting a specific price. For example, now on the Sensex you see 86,000 and it came down to 81,000. This is called a price correction. The second type of correction is known as the time correction. The prices may not correct, whereas market may not move up, market may not fall down, it may remain stagnant there itself. So this is called a time correction. A time correction can happen with price correction or without price correction. Both are a possibility. Market go and sit on the top, they do not move up from there, so they take more time to stagnate there. See, for example, let's imagine that the Sensex goes and sits there at 86,000, but it doesn't climb further up, and it spends 2 years there. That means 86,000 in 24, 86,000 in 25 and 26. That means you have used 2 years without giving any extra forward movement. This is also known as a time correction. Or markets will correct down. Now you are at 81,000. It will not climb up from there. It will not fall down from there. It may remain stagnant there for few months or a couple of years. That's a possibility. So you can see two types of correction: a price correction and a time correction. A time correction with price correction or without price correction. These are the types of corrections you can see in the marketplace. What is that the investors in you should be doing? If you are a serious investor, a correction or a market crash is no event in your investment journey. If you have enjoyed the bull market, please do enjoy the bear market as well. Invest at regular intervals of time. If you have started some plan because of which you are contributing a distinct amount of money into those plans or SIPs, please continue to do so. Because markets came down, crashing down, you don't need to alter anything. What you should avoid is do not buy into fashion of the day, something which was quoting a very high price just because it fell during a marketplace. Do not buy them. The best thing for you is always stay in the middle of the road. Stay in a diversified fund. Stay in a large cap kind of a fund. Build a scientific portfolio. Make best use of the financial planners to build your portfolio and have a long-term orientation. So nothing will prevent you from making tons of money from the market movements. Actually, for a serious investor, the market corrections are a great opportunity to buy at the lower prices. Do you want to make most of these market crashes? Do you want to remain at the center of the road? Do you want to build scientific professional portfolios? You can make best use of services provided by NRI Money Clinic. We at our NRI Money Clinic have built a team of experts to guide you in building portfolios as per your risk profile. If you have an intention to invest in the market under professional guidance, all that you have to do is our numbers are given in the description box below. We have provided a link over there. Click on the link, it takes you to the WhatsApp. Send us an exploratory message, what is that you are looking for, and our team of experts are ever ready to help you. Why delay? Send that message now. Dear viewers, the video that I have done today helped you to understand what is happening in the market. Is it a good event? It's a bad event? How you can make most out of it and how you can save yourself from the ill effects of the market correction. If it did give you the answers that you are looking for, please do give me a thumbs up. Those of you who are yet to subscribe for the channel, please hit that subscribe button right now and press the bell icon. Do not forget to share these videos with your near and dear one, friends and relatives, and on all the social media handles on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you next Friday with yet another thought on your life, your money. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.